Welcome to the Pro Ticker Deep Dive.
Great to be here.
Today, we're checking into the hospitality sector. I mean, on the surface, it seems to have completely shaken off the pandemic slump and is just running at full steam.
It really does.
But we have to ask a pretty critical question here. Is this global travel surge we're seeing a true structural renaissance, built on new habits? Or are we just watching the last fumes of pent-up demand burn off?
And that tension is exactly why we need to dig in. The difference between the dazzling headlines and some of the more subtle, worrying signals is huge.
So what's our mission today?
Our mission is to look right under the hood. We're going to zoom in on the two undisputed titans, Marriott International and Hilton Worldwide, and really understand the shifts happening.
Okay, so who is traveling where they're going?
Exactly. And the big operational risks, like labor, and then ultimately try to figure out why the market is pricing these two dominant companies so differently when they basically have the same business model.
Let's start with the big picture data then, because that context is everything. What's the overall health of the global travel engine right now?
Well, the story is far past recovery. I'd say it's thriving. Global hotel occupancy for 2025 has surged to 72%.
72%. And how does that compare to 4?
That's the key. This is 8 percentage points above where the sector was in 2019 pre-pandemic.
Wow.
And the gold standard metric, revenue per available room RevPAR, is also flashing green. It's up 15% year over year, hitting $112.50.
That $112.50 RevPAR, that's the vital sign, isn't it? It's the combination of how many rooms they're selling and how much they're charging.
It's the whole engine, yeah. But if those are the baseline numbers, the next question has to be, where is this demand actually coming from? Because the market has fundamentally restructured since 2019.
Okay, so let's start with business travel. The sheer dollars are back, right?
They are. Global business travel spending is projected to fully recover this year. We're looking at about $1.45 trillion.
Sure.
But, and this is a big but, the quality of that trip has completely changed.
And this is that famed leisure factor we keep hearing about, the blurring of business and pleasure.
It's not a buzzword anymore. It's a defining feature. The data shows a really significant behavioral shift. 58% of business travelers are adding their own personal, non-reimbursed days to their trips.
So they're extending a meeting into a mini vacation.
Right. 3 days on the corporate dime, 2 days on their own. And when they start paying for it themselves, the hotel stay becomes less about pure efficiency and more about the experience.
Which brings us to the real engine of their margins. Luxury and wellness.
That is where the premium pricing power is absolutely concentrated. The money is flowing to the top tier. Luxury properties are leading the pack at 78% occupancy.
78%.
And high net worth traveler demand has surged 34%. This is a demographic that is, pretty insulated from macro pressures. They want an experience.
And increasingly, that experience has to involve wellness. This isn't just about having a nice spa anymore, is it?
Not at all. It's a massive commercial market. Wellness tourism is now a $1.2 trillion market, and it's growing at a 15.6% compound annual rate.
That's huge.
It's enormous. And when a major hotel can combine, say, world-class health services with 5-star hospitality, think medical wellness packages, those drive 22 to 35% higher daily rates.
That is incredible pricing power. But with a market that big, isn't it crowded? I mean, how do global players like Marriott and Hilton defend against smaller boutique brands that only do wellness?
It comes down to scale. That's their moat. Marriott and Hilton don't need to be niche experts. They just need to funnel their millions of loyal customers toward these curated experiences. Their global reach gives them a lead.
Okay, but this recovery isn't happening everywhere equally. You mentioned some divergence in the data.
Yeah, significant divergence. And the U.S. market, which is still the bedrock for global RevPAR, is actually showing some real weakness.
How weak are we talking?
Well, the U.S. is about 40% of global RevPAR, and occupancy there is projected to be 2.4 percentage points below 2019 levels for the full year.
Below 2019.
Yes. And in fact, through mid-November, U.S. occupancy actually declined 4.1% year over year.
A 4% year-over-year decline in your core market. That sounds like a genuine cause for concern. Is that a canary in the coal mine?
It could be. It's probably a mix of things, but it definitely suggests demand is very elastic here. And you contrast that with other regions that are just soaring. Europe's at 73% occupancy.
In emerging markets?
Explosive. Mumbai, for instance, reported 84.6% occupancy with a massive 20.1% jump in RevPAR. So for a U.S. investor, that domestic softness really changes the risk profile.
Which sets the stage perfectly for our two titans. They're both operating in the split world using their core business model.
The asset-light franchise model.
Right.
And this model is their superpower. It's what defines their cash flow. They don't own the vast majority of the hotels. They just sell the brand name, the booking system, the loyalty program.
And in exchange, they collect high-margin fees.
Exactly. Which is why both companies are just returning billions and billions to shareholders through buybacks and dividends.
Okay, let's break them down. Marriott first. Q3 results showed that scale, but also the consequences of that geographic split you mentioned.
Right. Marriott is the scale behemoth. They beat estimates with an adjusted EPS of $2.47. Adjusted EBITDA rose a solid 10%. But the really important metric for their future growth is the development pipeline.
Which is just massive. It gives them huge visibility.
It hit a record, 596,000 rooms across nearly 3,900 properties. That provides years of assured unit growth, which means years of guaranteed fee growth.
But there's a catch in the numbers.
There is. Their global RevPAR increase of 0.5% in Q3 was entirely driven by international. International was up 2.6%. Asia-Pacific was up nearly 5%.
So their home market, US and Canada, actually saw a slight decline of 0.4%.
Precisely. Their global scale is currently shielding their domestic softness. International growth is essential for them right now.
So if Marriott is the scale play, Hilton seems more focused on sheer velocity and brand acceleration.
Hilton is all about aggressive segment coverage. Their Q3 was also impressive. Adjusted EPS of $2.11, EBITDA up 8%.
Yeah.
But the key move was launching their 25th brand, the Outset Collection.
25 brands.
They are relentlessly creating new brands to capture these really specific slivers of demand, making sure they have something for everyone. And they expect to return about $3.3 billion to shareholders this year.
Okay, but that rapid expansion relies on a healthy operating environment, which brings us to the headwinds threatening the whole sector.
And the biggest one remains labor. It's a major structural cost issue for the entire industry. This isn't cyclical, it's persistent.
And we're seeing some alarming vacancy rates.
Yeah, 68% of hotels report persistent staffing shortages. And you really feel this in the most basic jobs. Housekeeping has a 42% vacancy rate, culinary is at 39%. This just forces wage inflation across the board.
So, okay, the asset-light model shields Marriott and Hilton from paying those wages directly.
It does.
But it doesn't shield them from the consequences, right? If the franchisee's bottom line is getting choked by labor costs, that has to put a ceiling on how fast the parent company can grow its fees.
That is the critical point. Their revenue is a percentage of the franchisee's revenue. If that franchisee has less cash flow, they're less likely to invest, expand, or even maintain quality. That indirect friction is the Achilles heel of the model in this environment.
Another form of competition is coming from short-term rentals, the Airbnbs of the world. Are the Titans defending their moat effectively?
Well, they've captured huge mind share, especially with families and budget travelers. Marriott and Hilton have responded by launching their own extended stay and residence-style brands, but frankly, that moat is narrowing. They have to work much harder now to differentiate.
And finally, let's talk macro risk. If a recession hits, where does it cause the most pain?
It's concentrated in the lower chain scales. Remember that U.S. occupancy pressure we talked about? It's hitting budget and mid-scale segments the hardest.
So that signals people are very sensitive to price right now.
Extremely. When the macro environment tightens, the first thing to go is that discretionary mid-scale trip, or people trade down. The risk hits the cheapest parts of the sector first, and then could leak upwards.
All right, let's move to valuation, because this is where the market is telling us what it thinks about all this. And there's a huge divergence here.
A huge one. The market is valuing perceived growth acceleration very, very highly. Marriott, the reliable giant, trades at a forward PE of about 26.86x.
Okay, that's a premium, but it's manageable.
Right. They've had solid year-to-date gains of about 7.8%. But then you look at Hilton.
And their PE demands some serious conviction.
It really does. Hilton commands a forward PE of 42.45x. That massive premium suggests the market is pricing in years of flawless execution, and it's paid off so far. Hilton's up almost 12% this year, outperforming Marriott by over 400 basis points.
42 times earnings is steep. The market is almost treating it like a tech stock. What happens if Hilton misses on just one quarter?
The risk of that multiple compressing is significant. A 42x valuation demands macro stability and continued outperformance. Technically, looking at the charts from late November, Marriott's uptrend looks solid. support around $280, resistance at $310.
And Hilton.
Hilton's holding support at $265, but it's more sensitive to any kind of disappointment.
So if we synthesize this whole deep dive, the split demand, the labor risk, the valuations, what's the core takeaway for an investor looking in this space?
Look, the sector's uptrend is intact, supported by those fantastic asset-light models. But the story's now a choice. Marriott is your defensive quality play. The scale, that record 596,000-room pipeline, the geographic diversity, it's a reliable, lower-risk entry.
And Hilton is for the growth-oriented investor.
Exactly. Hilton is for the growth-leaning investor. The brand velocity is appealing, but that 42.45x valuation demands that you believe this pace can continue, even with the softening U.S. market.
And the big overarching sector risk.
It remains that demand bifurcation. This whole story is being driven by luxury and wellness pulling everything higher. If the stress we're seeing in mid-scale and budget starts to leak up into those higher tiers because of a recession, the entire thesis changes overnight.
It brings us right back to that friction point we talked about.
Yeah.
Given the strength of these models, how much operational friction can the franchisor absorb from rising labor costs, with 68% of hotels reporting shortages, before it really starts to impact the fees they get from franchise profits? That's something serious for you to mull over.
Indeed it is.
See you all in the next Pro Ticker Deep Dive.